Saurabh Mukherjea, founder with Marcellus Investment Managers. It's an interesting choice of the firm's name.
Right. It's Muhammad Ali's middle name. So he was Cassius Marcellus Clay.
Yeah.
And Marcellus also means little warrior. So I might not be little anymore, but I thought it's a good name to begin a new career with.
Yeah, but investing is all about keeping patience and long term.
Yeah.
And a boxer is about 3 minutes, 4 minutes, slug it out in the ring, smash and grab.
Right. But Muhammad Ali, the only man to win back the world title 5 times over the course of 15 years. So long career, very successful career.
Consistent performer.
Patience career, yeah.
Okay. What's happening in the market? I mean, it's not that all the concerns in the world are over. It's a rarity to see a print of a record high on the Nifty and a print of new low on the rupee.
Yeah.
Historically, these things don't go together.
I think in a way the two are helping. It's clear that the weaker rupee has helped the IT sector, and it's now helping the pharma sector. If you look at 1Q results, the sector which produced the biggest earnings surprises was pharma. And if you look at the last 4 quarters, Nikunj, IT was the sector which is consistently surprised in the upside with earnings. And I think this will carry on as the rupee heads from 71 perhaps to the 75 type mark. I think IT and pharma are big winners. Auto ancillaries who have export franchises, firms like Balkrishna, which I saw you guys flashed up, or in MM Forgings, these sorts of companies have 60-70% of the earnings coming from abroad. Those sorts of auto anchors will also benefit. So the weaker rupee, I think, is good for the market. It will help companies with big export franchises benefit. But more generally, the economy is chugging along reasonably well. Consumption, even the sort of lighter end of capital goods such as cement spending is picking up. And I think that will continue till the election. The main concern remains for me the BFSI sector. Valuations are stratospheric, whether it's the bank you were just discussing or housing finance. It's unbelievable valuations in a rising interest rate, rising inflation environment. That's a very worrisome combination, I think, for BFSI.
That's 40% of the market, which
Absolutely.
means 40% of the market is not looking good. If half of the market is not pumping or beating, that means it's trouble.
I think at the overall index level, I think the index does look overvalued, particularly because BFSI looks a good 20-30% overvalued. And the history is very clear. Every time monetary policy in America tightens, 2006, 2008, 2013, every time the cost of money in America goes up, BankX corrects 30-35% in 6 to 7 months. So the writing is on the wall, with oil rising, with inflation picking up, with RBI. I think another 2 rate hikes from the RBI this side of the election looks likely. I think it's really high time for people to consider exposure to BFSI, particularly housing finance companies. I think that's the sharp end of the BFSI conundrum.
Saurabh, you in your latest note have talked about creative destruction in the Indian market, and rightly so, taking a leaf out of your own note. Be it roads, phones, internet companies, low-cost flights, that destruction is just about everywhere. But where is that undiscovered destruction which is either waiting to take place or hasn't been discovered fully by the market?
Absolutely. So I think one of the most interesting stories in India in the last decade has been the rise of smaller town Indias. Cities like Ludhiana, Coimbatore, Pune. These cities have grown enormously. They've become very prosperous. And the more I go into that world, I realize that the rise in connectivity, better roads, telecom, electricity is helping small town India boom. So what you're getting is a whole slug of regional players who are expanding their ambit, expanding their umbrella, and gradually becoming national players. So 3 examples would be, say, La Opala, Astral Poly, and take, say, someone like Green Lamp. Right? If I go back 10 years ago, firms like La Opala or Astral Poly, market cap would be 150, 200 crores. And now the same firms, La Opala has 3,000 crores, Astral Poly is, I think, 9,000, 10,000 crores. You can throw Kajaria in the mix. Kajaria, Astral Poly, La Opala, 10 years ago, 150, 200 crore firms, now market cap anywhere between 3,000 to 10,000 crore, driven by the ability to go from being a regional player to a national player. And that story I'm seeing getting replicated across numerous sectors, whether it's in B2C or in B2B. I think that'll be the big story of the next 10 years. And the BSE 500, the BSE 500 that we see today, half the firms in the BSE 500 today will not be there anymore. And a new bunch, 250 to 300 new firms will come into the BSE 500. That's the churn to play for. The change in a way is not so much in Mumbai or Delhi or Bangalore. The change is a little far away, and that's where the really exciting opportunities are.
The markets are at record highs, and typically at a time like this, and we compare it to the same time in the previous bull market, you had a slew of IPOs hitting the market, but you're talking about the IPO pipeline drying up at a time when the markets are at record highs, the rupees at a record low.
So I'm not so sure that the IPO pipeline itself will be the big source of opportunities. If I look back at the IPOs of the last couple of years, I think really good IPOs.
No, I know, but a burgeoning IPO market reflects that the markets in general are moving towards froth.
Right.
That may not be the case this time.
I think the IPO market in a way sort of peaked, the IPO frenzy peaked, I would say, around 6-7 months ago. In a way, we are sort of tapering off because private equity is the main driver of IPOs. Now, it's not so much promoters saying we need to run to the stock market and cash out at the top. It's more private equity who's driving it. And the classic sign of a market top is a very narrow market, which we have for better or for worse today. A narrow market driven by 6 or 7 stocks. So you've got BFSI at full throttle, 40% of the market. No sector ever in India has been so much in the Nifty. A narrow range of leaders and whole monetary policy tightening both at home and abroad. That would suggest the overall market looks toppy. But underneath that toppy market is creative destruction, where smaller companies, well-run small companies are coming through very strongly. Say take a company like Forgings, right? Not a frontline auto anch player, but steady 10-year numbers, a solid franchise in forgings. 2/3 of the revenues, I think, come from exports. Rupee weakening. Those sorts of firms should be the things to look out for.
When you say you are also excited about owning small companies which could become big companies in the B2C segment, B2B is again a difficult business for some of our viewers to understand.
Right.
But the minute you say B2C, they can understand the brand, feel the brand, or they know about the brand. Give me an example of disruption in the B2C segment.
So let's take a straightforward example. There's a firm called Amritanjan, which makes...
We all know about it.
Balm, yeah. So
it was a late night for us, and we'll be using a lot of Amritanjan today.
So it's a great intro. So now they're very strong in South India and Eastern India. So Odisha, Bengal, and South. They're so strong that the Jhandus and the Vicks of the world haven't been able to dislodge them. Market cap is 800-900 crores. The land that they own is itself around third to half of the market cap. ROCs are 20-21%, 15-20% growth, steady regional franchise. Now, will the promoter scale it up and build a pan-India franchise? I haven't got an unequivocal yes from him at the moment. But a brand like Amritanjan in the new networked India, I think has several opportunities. And whether it's because of organic growth or because, say, a cash generative FMCG major says I need to bolster my South India franchise, whichever way you cut it, these sorts of firms look very tasty to me. There's very little debt on the balance sheet, so you're not dealing with indebted, high debt equity-ish stories. You're dealing with cash generators, in a way the smaller version of Coffee Can. You're dealing with the mini version of Coffee Can. Firms who had a good 5-6 years and who look to have the potential to give you 10-20x over the next 10
They
next
moved into juices and female hygiene. I think those are the 2 areas of expansion.
Right.
So I'm not really kept pace with what they're
So you're
doing.
very well informed. So what they're doing is they're taking the same channel that they've built and they're selling more through the channel, right? And my reckoning is they'll both try to take a leaf out of Vicks' playbook and Jhandu's playbook, plus they're trying to pump more through the channel. Now, small firms like this will make 1 or 2 mistakes along the way. But if the underlying capital allocation is sensible and the ROC is strong, you've got a very powerful earnings engine there which can create wealth. And that's why I cited firms like Laopala, Astral and Kajaria as examples of just how much wealth a well-run small company can generate.
But tell me a little bit more about your coffee can style of
Right.
investing. How is it that you pick out these emerging champions? Is there a methodology to it?
Sure. So there are sort of 2 anomalies in the Indian market which allow you to make money consistently. One is the coffee can, and I think sitting in this chair, I explained how we look back at the last 10 years, look for 10% revenue growth and 15% ROC. But when you go into the world below the BSE 500, you don't really have small companies with such stellar track records. So what you're looking for is over 5-6 years, have these firms grown the business, whether it's in revenues or gross block, have they grown the business over the last 5-6 years? Has the growth been profitable? Have profit margins improved as the business has scaled up? And has the growth come from internal funding rather than having to rely on QIPs and bank debt? So if these 3 criteria are met, right, consistent growth, self-funded growth and growth accompanied by margin expansion and profitability expansion, I tend to get very interested. So it's a bunch of meetings with management. I sort of track down people who know the company well, distributors, dealers, and you get a fix on the quality of the management, the work ethic and the drive of the management team. And there are typically at any given point in time Aisha, I found there are around 15 to 30 companies who comfortably fit into this slot. And interestingly, very few of them come to Mumbai for broker conferences or for TV studio appearances. So that leaves people like me.
We'd love to have them,
Right,
provided
so-
you can fix it up for us.
So they don't like the limelight, which means people like me can discover them and quietly build a position.
Now, what do you like about Page Industries at these levels?
So Page continues to be a coffee can counter. It's been, I think, it was my first book 4 years ago. It's, I think, given about 30x in 10 years. And there's perpetually this concern that it's overvalued and tomorrow morning it'll correct and we'll lose our shirts.
Or maybe not even correct. It's just like, why would I go in for Page Industries when you're talking about, especially the other approach?
So Page actually the classic story of a firm which came out of nowhere 25 years ago and built a pan-India brand. And in the undergarment space, it's not obvious to me anybody else is remotely close to this company. They started with women's innerwear, men's innerwear, kids, now loungewear. They're consistently growing the business into adjacencies, and ROCs are approaching 50%. So it remains a holding for me. I remain a steadfast fan. I know it's expensive, but coffee can franchises have this ability to give you 200x over 20 years. So I'd rather hold out for that than cash in early.
What role do you think cycle will play? Because ultimately markets, they follow a cycle.
Absolutely.
We think things are immortal in market, but it never works. Cycle will always have a role to play. So for, let's say, Page or an HDFC Bank, some Bajaj Finance, these are good. iSure, these are good companies, and I can see they will continue to grow. Whether growth is 10%, 15%, or 8%, that's the debate. Growth is there. It's like India's GDP. 5, 6, 7. That's a debate. India will grow.
So I think the very interesting thing about the market is our market bifurcates nicely into sort of sectors which are very structural. IT, pharma, FMCG, no great secret there. And there are 3 sectors which are intensely cyclical. Right? They are BFSI, banks, metals and capital goods, intensely cyclical sectors. So if you want to be a large player in these 3 sectors, and in a way by default everybody now is a large player in BFSI, you've got to have a really good fix on the cycle, right? I'm not saying I'm the world's greatest expert on the business cycle, but whoever today is playing heavily in BFSI, metals and capital goods, better have a really good fix on macro, i.e. 3 specific things: GDP, interest rates and the repo rate cycle. To my mind, the interest rate cycle is the main thing to look at the moment. The cost of money has risen. I think will rise further over the next 12 months, potentially with an upside surprise, which is why the BFSI piece worries me so much. So there are 3 parts of the Indian market which are very susceptible to cyclical corrections: banks, metals and capital goods. Outside that, sectors like auto, consumer, IT, pharma, FMCG, there is typically not that much cyclicality. So if you have a good structural holding in your portfolio, such as Page or say an Asian Paints, history shows that it's been folly to trade in and out of it. Asian Paints is up 1500x since its IPO in '83. There must be millions of sort of people out there who have tried to time Asian Paints over the last 25 years and failed. And I think Page feels like, at this juncture, touchwood, Page feels like a similar story. You try to time Page, and I've tried it myself before I gave up, and it doesn't work. So in sectors which are non-cyclical, in a way, auto, pharma, IT, FMCG, there's no point trying to sort of catch the ups and downs. There are 3 other sectors where you can do that to your heart's content: capital goods, metals and banking.
So when people come on those shows, say it's a good business, but stock is expensive.
Right.
What should one do then?
Right. So obviously there's got to be a practical way to gauge this, and typically what I look for is not just the earnings growth, but also the return on capital employed.
Why are you sounding different to me in your new avatar?
Right. So the return on capital. So this is why one of the reasons I decided to do investing full time was I figured out that I could make more money doing this for myself than I could running around the world investing, giving broking advice to others. Anyway, so to come back to the point on valuation, I think return on capital employed is the critical metric. Everybody obsesses about earnings growth. If ROC is well above the cost of capital, as it is for someone like Page, that is the premium that you command. And if you sell a company with high ROC, you're basically giving up someone who's a cash machine.
No, but I look at Marico, I look at an HDFC Bank, and I get your theme about consumption not being cyclical, but you're saying that banks have a bit of a cyclicality.
Banks do, yeah. So,
but you're still high
true.
on.
So I think HDFC Bank deserves a lot of credit for being exceptional. I think when I wrote The Unusual Billionaires, I just realized how exceptional HDFC Bank is. It deserves a lot of credit for being a structural play in a cyclical sector, and it genuinely is exceptional. Very few. I haven't seen any other lender, to be honest, who's been able to pull that off. A structural play in a cyclical sector is almost walking on water, and all credit to the people behind that bank for pulling this off.
Can Bajaj Finance be that one? Because now the way people are valuing Bajaj Finance is that there is a cycle, but they also have an advantage of understanding of the consumer insight. I mean, our understanding of Bajaj Finance model is that they are essentially leveraging the same customer more, and the same customer wants a mobile phone, he wants a car. I read an ad where Bajaj Finance is saying, get your hair back and pay money in EMI. Essentially, weight loss and hair transplant. Now, trust me, I saw an ad of Bajaj Finance where they're offering this kind of service.
Now, I saw on the internet shopping sites, they even giving EMIs for buying my book.
Okay.
So
is that expensive book?
It's all books are now available on EMI. Put it like that. But I think the key concern I have for the high end of the NBFC market, the top quality NBFCs, in that the key raw material is money.
Okay.
And it's not evident to me that any of them have a competitive advantage when it comes to getting money from the wholesale market. And I think until I can get my head around that, it's difficult to put BAF in the coffee can category. HDFC's CASA franchise, the unique CASA franchise that they built, gives them a competitive advantage, which others have tried to emulate, but not to the extent of success HDFC Bank has had.
What keeps you worried though? I mean, these are the micros, these are the stocks, the structural story. But would you say on a macro level, the currency, crude, US interest rates, are those worry factors?
I think the
Could
big
that
worry,
be a challenge?
the big worry is I was writing a newspaper editorial on the anniversary of Lehman Brothers. The big worry is if you look at India now versus India 5 or 10 years ago, the crux of our banking system is gone, right? The PSU banks are gone. As a result, our economy is now almost entirely funded by our wholesale markets, right? And the Bajaj Finance example illustrates that point. As a result, whenever liquidity tightens in America, and it will one day, it will ripple straight into our economy. In the past, the PSU banks, rightly or wrongly, gave us a buffer, which meant that global shocks had at least some buffer before they hit our real economy, although the stock market would move very quickly. Now we don't have that buffer. So in a way, we are more exposed now to adverse events in the Western world than we were 5 or 10 years ago. And that's something we need to reckon with. Anybody who talks of decoupling and all of that nonsense needs to reckon with the fact that with the core of our banking system gone, we are intensely exposed.
There's no cushion now.
There is no cushion to a Western liquidity shock.
So how does one go about investing in this market? Because macros are not great. Globally, we know that things are not exactly very straight lined. If global risk comes back and if there is a liquidity crunch, then we will be hit, and we will be hit hard. And small cap stocks and mid cap stocks, they will get crunched because there will be no liquidity.
Sure.
So if the proposition is that you buy small and mid cap stocks because that's why you will be able to generate greater returns,
sure.
How does one invest in this kind of a market?
So I would say what I'm trying to do, and I'll be very candid about it, part of my portfolio is structural plays, whether it's coffee can type structural plays or high quality small cap companies which look to have a great future. And the other part of my portfolio is where I think I have some fix on the macro cycles. Say if I have a fix on where the rupee will go, I'm trying to be opportunistic about buying IT, pharma, and auto exporters who I think will benefit from the rupee. So make part of your portfolio a play on the macro cycle. Choose a metric in the macro world which you feel very comfortable second guessing. It's tough to do it, but if you want to do market timing, choose a macro metric which you're very comfortable second guessing, and currency is the one I feel most comfortable with, and choose macro plays who benefit from a weaker currency. And the other part of your portfolio, arguably the core of your portfolio, make it structural long-term plays where you don't wake up every morning, look at the PE multiple and go, oh my God, it's expensive and I need to sell it in the next 5 minutes. And I feel that way you're both dealing with your itchiness to do something in the market and react to macro news. At the same time, you're giving structural compounders like Page the opportunity to generate wealth for you.
Interesting thoughts. Yeah, and fairly engaging conversation. Thanks very much.
Very kind.
Saurabh, all the very best.
Thank you
Thanks
very
very
much
much for stepping in this morning for a chat.